Berachain just launched its mainnet about 4 years after starting as an NFT project. Along with it came the airdrop of its token, which got mixed reactions, and a listing on several major exchanges. The project has raised millions in funding and, at the time of shooting, has already broken into the top 10 blockchains by TVL with over 3 billion locked. So, besides its meme-like name and origins, let's dive in to see what Berachain is and what the hype is all about. Berachain is a layer 1 blockchain that's fully compatible with Ethereum's virtual machine, meaning any Ethereum-based application can run on it without needing changes. But the unique thing that it's bringing to the table is its consensus mechanism, POL, or Proof of Liquidity. Instead of validators just locking up tokens to secure the network, they also have to provide liquidity to Berachain's DeFi ecosystem. This means network security is directly tied to on-chain economic activity, ensuring that assets stay in circulation rather than just sitting idle. Before coming up with this idea, the founders were actually working on an NFT project called Bong Bears back in 2021. It was built around a rebasing system, which basically meant that owning one NFT would get you more NFTs over time. Fast forward to 2022, and the same team, pseudonymous developers Smokey the Bear, BERA, and Def Bear, decided to expand on their idea and founded Berachain, keeping the bear theme alive. They managed to raise a serious amount of money. Their first big raise came in 2023 when they pulled in 42 million from investors like Polychain Capital, Hack VC, Shima Capital, Robot Ventures, and Tribe Capital. They followed that up with another 100 million round, co-led by Brevin Howard Digital and Framework Ventures, bringing their total funding to 142 million. Then early last year, they launched their public testnet, which became one of the ways to reward active users with an airdrop before finally launching their mainnet this year. So, how does it work? Now, as we touched on earlier, proof of liquidity is what makes Berachain different. Unlike traditional staking, where validators just lock up tokens, POL requires them to keep assets actively circulating within the network. It might get a bit confusing, so bear with me, get it? But the key is to remember it's a cycle. It starts with validators who stake BERA, the native gas token, to secure the network. The more they stake, the higher their chance of being selected to propose blocks. In a regular proof of stake system, validators stake tokens and receive rewards, like staking ETH to earn more ETH, which can be kept or sold. But the twist with Berachain is that validators who stake BERA don't earn BERA directly, but instead in BGT, a soul-bound governance token that can't be transferred or traded. How much BGT validators receive comes from two separate emissions, a base emission and a reward vault emission. The base emission is a fixed amount, which goes directly to the validator as a baseline reward for securing the network. The reward vault emission, however, goes into the validator's chosen reward vaults, which are created by DeFi protocols looking to attract liquidity. Now, we'll touch on this in a bit. And unlike the base emission, it's variable and depends on the validator's boost, which, as the name suggests, increases the amount of BGT that they'd earn. A validator's boost is determined by how much BGT has been delegated to them by users who are providing liquidity, aka liquidity providers. Since BGT tokens aren't transferable or tradable, validators must compete for it. To attract delegations to increase their boost, that's where the reward vaults come in. As mentioned, validators direct a portion of their BGT emissions to these vaults, which benefits liquidity providers. How this works is that when users provide liquidity to a DeFi protocol on Berachain, they receive liquidity, or LP tokens, as the receipt tokens, so to speak. You may already be familiar with this, as it's essentially the same model used when you provide liquidity on any DeFi protocol. On Berachain, though, liquidity providers validators can then deposit these liquidity tokens into the reward vaults, where they can earn BGT that the validators have directed based on their share of the vault. But that's not the only incentive at play. When a validator directs BGT emissions to a protocol's reward vault, they also receive additional incentives from that protocol, usually in the form of its native tokens. Now, as expected, this influences the validator's decision to choose a specific protocol over another. Validators are then expected to share a portion of these incentives with liquidity providers who delegated to them. All this is meant to create a self-reinforcing cycle where validators compete for more BGT delegations by directing more BGT to the reward vaults that are offering them the most incentives. Liquidity providers, in turn, seek out validators that offer the best returns, creating competition between both validators and DeFi protocols that ensures liquidity moves efficiently across the network. Meanwhile, DeFi protocols benefit from increased participation as more liquidity flows into the ecosystem. In the end, BGT holders can vote on governance proposals, earn a share of dApp fees from core Berachain applications like Berachain DEX, or burn their BGT one-to-one for BERA. As for BERA's tokenomics, the total supply is 500 million tokens with 10% inflation annually. Of this, 16% went to core contributors, 34% to investors, and 48% to community allocations. Of the community share, 15% has already been airdropped to users, 13% is for future initiatives, and 20% for ecosystem development and research. However, the tokenomics and airdrop distribution have sparked debate within the community. One major criticism is that over 34% of the initial supply was allocated to early investors. While their tokens are initially locked, they can still stake their BERA, earn BGT, burn BGT for more BERA, and then sell these tokens. Many feel that this wasn't clearly communicated by the team up front and gives private investors an unfair advantage. Berachain's head of DeFi responded to these concerns by pointing out that 84% of staking rewards go to reward vaults, meaning only 16% benefits early investors directly. The airdrop distribution also caused frustration, especially among testnet users. Many early contributors expected larger allocations after months of engagement, but received far fewer BERA tokens than anticipated. Adding to the controversy, one of Berachain's co-founders, DefBear, reportedly received 200,000 BERA from the airdrop and sold portions shortly after the launch. This led to accusations of insider benefits and a lack of transparency. Its ecosystem, however, has been a much more positive story. Berachain's network has been growing rapidly, with over 100 projects already launched or in development. Its TVL surged past 4 billion, placing it among the top 10 blockchains by TVL. Contributing to this TVL includes dexes like Kodiak and Bex, as well as lending platforms such as Dolomite, an Arbitrum-based decentralized exchange. But the biggest protocol so far is Infrared Finance, a liquid staking platform designed to help users make better use of BGT by introducing iBGT, a liquid version of the token. Berachain's current plans are all about evolving governance and expanding the network of BGT-eligible vaults, both for dApps on Berachain and any future layer 2s on it. Well, that's everything you need to know about Berachain for now. Its proof of liquidity model is for sure an interesting one, but the real question is whether Berachain can sustain its momentum once the initial excitement dies down. So, do you think POL has what it takes for Berachain to compete with other layer 1s? Let us know in the comments below.